Hello again, everybody. I am Randi Braun, and welcome to Something Major's Let's Do Lunch, Marrying Your Money to Your Goals. We are so glad that you are here with us today, and please pop into the chat where you're joining us from. While we wait to hear from you, let me go ahead and introduce myself. Again, I'm Randi Braun. I'm an executive coach and the CEO of Something Major, a women's leadership coaching and advisory firm. I want to thank you all for coming today and say good morning to those of you who are joining us on the West Coast. Good afternoon to those of you who are joining us on the East Coast. I see that we have some Washingtonians. I know we have some New Yorkers here with us today. Eryn, who I'll be introducing in a moment, is also here with us on the East Coast. Oh, wow, we have Canada, we have Cambridge. This is so fantastic. I just want to thank you all again for coming and welcoming you. Something Major is dedicated to empowering working women and working mothers to live their very best lives, feeling more fulfilled, more successful, less burnt out, and like they are living and leading on purpose. Money is an important part of that equation, and it is the part that we rarely talk about. That is why I am so thrilled to have my friend Eryn Schultz here today for a conversation about how we can marry our money to our goals. For those of you who are return attendees to these series, welcome back. To those of you who are new, once a month we sit down here at Something Major with all of you for a session called Let's Do Lunch. Born out of a lack of connection in the pandemic, the origin story of this gathering is that I missed my friends, and so do you. So each month I'm bringing one of the accomplished women in my life who I have the privilege of calling a friend to come chat with me and come chat with you about something they are passionate about. Of course, as we thought about a conversation about marrying our money to our goals, I could not think about a better speaker and a better friend to have join us, my longtime friend, Eryn Schultz. Eryn, hi, I'm so excited to have you with us today.
Hi, Randi. Thank you for hosting and for creating this space to, talk about important topics like money during this pandemic.
I couldn't think of anything more important. Eryn, time is so elastic in the pandemic. The last time you and I were in a Zoom webinar together like this, I believe we were talking to staffers at the US Congress. So I'm so excited that we could democratize this conversation and bring it to the Something Major community. So thank you for being here today.
And thank you for having me, Randi. I'm excited to dig in.
Let me start, Eryn, by just introducing you properly to everyone. Obviously, aside from being a longtime friend, I'm not going to tell everyone how long we've been friends for, because then they'll start to do the math and we'll date ourselves. And I'm now at the age where I'm not so interested in having people do the arithmetic on my age. But in addition to just being my friend, Eryn, I just want to read our group, our participants, the folks who are going to be watching this on record, a little bit more about your background. So again, for those of you who are just meeting Eryn, besides being Randi's friend, more impressively, Eryn is the founder of Her Personal Finance. In 2015, Eryn graduated from Harvard Business School and realized that she and her classmates were better equipped to manage a corporate balance sheet than their own finances. So she created a 10-week money boot camp to help women answer questions like, how much should I save for retirement? How much should I buy a house for? And how much house can I afford to buy? How do I pay off my student loan debts or save for my kids to go to college or maybe go to Harvard Business School if they're a smarty pants like Eryn? Eryn's also extremely humble and modest, so she's laughing, but trust me when I tell you, I know she's dying on the inside. So, Eryn, I do just want to make a disclaimer to everyone that you are a women's wealth educator and not a registered investment advisor at this time. So you are here to share ideas, not to sell us on particular stocks or funds. And if our participants have questions about buying a specific stock or fund or 401k plan or whatever it is, they should talk to a registered advisor, to their accountant. But we're here to have a conversation about smart things smart women can do to smartly marry their goals to their money. Okay, so now that all the disclaimers and the caveats are gone, we're going to jump into our conversation. We got some questions in advance. I know that our group here has questions, and so I just want to remind you, those of you who are joining live, please feel free to throw your questions into our Q&A box. We want to hear from you. And Eryn, we have such a wide range of people who are joining us today. We have people who are employed in corporate jobs and people who are self-employed. We have working moms and non-partnered women who are joining us. So I'm really excited to have this wide-ranging conversation with you. As we jump in, let's just start with kind of the origin story for her personal finance. You know, we talked about your experience graduating from Harvard Business School. Tell us a little bit more about what got you interested in helping women become more financially empowered.
Thank you for that wonderful introduction, Randy. You definitely made me blush. But in terms of what got me started on this path, first, I've always just been a numbers person and interested in money. But right out of business school, I had taken a job working for a retailer back in Texas and was starting to have a lot of conversations with people at work about the 401k plan because, you know, we sort of realized for the average American, what's the difference between a stock and a bond? You know, what's a Roth versus a traditional account? People ask me all the time, who is Roth? I'm like, don't worry about who he is, worry about what the account is. But I started to have all these conversations at work about 401k plans and saving for retirement, and started to carry that into my personal life. And I'm from Texas, was living in Houston at the time. And quite frankly, I got really sick of people falling into two buckets, either my married friend saying, my husband manages my finances, which wherever you feel about money, you should at least be involved in those decisions because it's too important of a topic to totally outsource to someone else. And then some of my single friends, I think, were sort of hunting or wanting to wait to make some big financial decisions, not knowing if they were going to find the right person in the next couple of years, and really wanted to create a space to answer people's questions, make it less of a scary topic, and help people feel like they can do it today, whatever stage of life they're in.
Yeah, and I know that I personally just died a little bit inside when I was like, oh, I'll let my husband deal with that, partly because I got married at a really young age. Nobody had ever talked to me about managing my money. And so I had like the cringiness of just knowing that that's a cringy thing to say and think. I have the cringiness of knowing that that's been my experience. And, you know, one of the things I see all the time with some of the women who I work with is they are at the top of their games at work. They're at the top of the game in their organization and on their teams. And so they know a lot of things. And so when they don't know something, it actually feels really, really intimidating to them. And so I love that we're having this conversation. And again, we want to encourage you, submit your questions. You can throw them into the Q&A anonymously if you want. But Eryn, you know, aside from the fact that we can't just rely on our partners to manage our money for us, you know, help me understand a little bit more. Why is it so important from your perspective that women take a more informed and active role in thinking about their finances, their financial longevity, and their financial goals?
A lot of reasons, you know, and I also want to be inclusive to, if, you know, you're not in a heterosexual relationship, like I think this applies no matter who your partner is. But, you know, and I think about my grandmother who became a widow at 89 and for the first time in her life was solely responsible for her finances. And unfortunately or fortunately, women tend to live longer than men. So even if you are in a partnership, you know, at some point in your life, it's likely that you're going to be responsible for your finances. And I'd much rather have an idea or have some sort of input in that decision-making process versus having put it on someone else. A, I think it puts a lot of stress on your partner if they are having to make those decisions, whatever that partnership, married or not, looks like. But B, I think that money is key to so many life decisions. You know, it's what gives you financial security. It's what enables us to buy the home we want to have or pay for education for our children or be philanthropists. And I think that women tend to feel intimidated by the topic of finance. We're also known to be more conservative when we invest. We tend to not put as much money in the stock market. You know, Wall Street Bets, the whole GameStop saga, driven in a lot of ways by more male investors. And so I think that makes
Eryn,
helping
can you talk
women...
to people just really briefly about what happened with GameStop? Because this was such a crazy story about investors triggering this huge market event. And what was so incredible that it was overwhelmingly initiated by men. So I know it's like you just mentioned it in passing. Could you give us like the 20-second overview of what happened if we have an attendee here today who has no idea what we're talking about? I personally was fascinated by this story.
I thought it was really fascinating as well. And it's interesting because it's still ongoing. The CEO of GameStop actually just exited the company last week. So it's still ongoing. But to summarize, so GameStop is a small company. Most of you probably know it because you've seen it in a mall, and they sell Xboxes and other games. As more and more games are being bought online, though, a lot of people were betting that the company's revenues were going to go down. And something that I think, and beyond revenues, that their profits are going to decrease over time. So something that I think is interesting is that the value of a stock, and sometimes people lose sight of this, is technically when you buy a stock, you buy a percentage of that company's future earnings. So you own one share of the company. And so the worth of that stock should be tied to how we think the company is going to perform. But one thing that was interesting is that a couple of hedge funds, which are basically big Wall Street firms that have a lot of capital, said, we believe that this company is going to do worse over time. So instead of buying the stock, we're going to do something called short selling. And I'm not going to go into detail on what that is, but basically you borrow the stock from someone else and you say, hey, I'm going to return it, assuming that the stock is going to go down in value. So I use this as an example, like if you borrowed your friend's necklace, assuming you could buy it from her at $100 and that you could return it to her when gold is worth less at $80. And I hate that I used a gender example. You could replace, your friend's necklace with their computer or any sort of item that has intrinsic value. But so when you short sell, you're betting the value of the stock is going to go down. And so what happened with GameStop is that a couple of hedge funds actually were kind of silly, in my opinion, and made a bad decision, and that the vast majority of the shares of the company were being shorted. And this was seen as an opportunity because if everybody's betting that the stock is going down, but again, you're borrowing these shares in order to do that. So someone in Wall Street Bets, this Reddit forum, saw this as an opportunity and said, let's screw the hedge funds. They are at risk, basically, because of this move that they made. So people started to buy up the stock in mass. And the crazy thing is that Wall Street Bets...
Which is so crazy that we're moving markets on Reddit, right? And this whole crazy saga triggers. And I just want to remind people, right? Because this is a really women's-oriented space. Anyone who if you've been to something major event, anyone who self-identifies as a woman or as an underrepresented non-binary gender, this is the place for you. So let's just talk about this huge market event was triggered by dudes. I mean, dudes sitting on their computer while we're taking up the disproportionate share of office housework in our offices, of housework in our homes, especially if you're a parent. And this is so demonstrative of what the knowledge gap is between men and women, right? And I know that you're going to say something, but what I was going to say is that, it's so important, Eryn, and that's why I'm so glad that you're here, that we have this forum to talk about money. Because one of the things that I'm really conscientious about is the fact that we already make less money. So if we make less money, right, we know that women make about 82 cents on the dollar as compared to men. We know women entrepreneurs, I know we have some entrepreneurs with us here today, make 78 cents on the dollar as compared to our male colleagues. I say that as someone who's self-employed. Women and working mothers, according to the National Women's Law Center, make as little as 69 cents on the dollar compared to working dads. And by the way, these are aggregated averages that really do increase that wealth gap, or that compensation gap increases profoundly for women of color, specifically Black women and Hispanic women in America. This is a crisis. We need to be able to manage our money better. So that's my battle cry for this conversation.
I love that, and keep that battle cry. But the thing I want to push on is you were like, there's a knowledge gap here. And what I will say is that in this instance, you can invest or you can gamble. And to me, this is a great example of GameStop of people gambling. Because if you Google GameStop stock and you look at the 1-year trend, it goes it was trading at $6 a share, and then it jumps, and then it's doing all of this up and down. And I'm a big believer in investing for the long term. I don't pick individual stocks. I buy things that are called index funds, where I'm buying a basket of stocks, because I don't want to have to try to guess, is the Pfizer vaccine going to do better than the J&J vaccine? I'm not a scientist. I don't know. Is GameStop going to succeed, or is it not going to succeed? I don't know. So I try to buy a basket of stocks. So I will say that men drove this crisis. I do know women that bought GameStop and invested in GameStop, but to me, it's actually an example of what not to do. And yes, some people made a lot of money, but some people lost a lot of money. A lot of hedge funds ate their shirts on this, and individual investors lost a lot of money on this too, because they were trying to time the market. And like, again, if it's going up and down, like some people were going to get caught holding the bag. So this isn't an example of like, gosh, like women should have been part of this. I think it's more an example of God give me the confidence of a mediocre white man. Like if they're confident to like
preach
put all
on
the money
that
on GameStop, you should feel okay investing in the S&P 500.
Yeah, and actually, Eryn, I love. We're going to send Eryn's Instagram handle along to all of you after this session. If you just want to get smarter every single day, just follow Eryn on Instagram. Her stories every day, I'm sitting there, I'm like drinking my coffee in the morning, scrolling, and I feel like I'm getting wealthier and better educated just by engaging on social media. So I guess, Eryn, thanks for justifying my Instagram habit. But Eryn, one of the things that you do on Instagram that I love is you play with these scenarios about, here's what I would do if I took $20,000 and my $20,000 bonus and spent it on something today versus putting $10,000 into an S&P 500 fund, which I understand is kind of like, I don't know if it's like the golden goose of index funds or the most reliable, whatever metaphor that you want to use. Can you help us understand about how just even putting some more money in an S&P 500 index fund can help us grow our wealth over time?
Sure. So most of you probably have heard the term, at least, compound interest. And if you want to go to the investor.gov compound interest calculator, it's pretty cool because the government has this free resource where it will actually show you, if you invest over time, how much is the value of your contributions, and then what will that grow to? And the basic idea of compound interest is if you start with $1,000 and it grows at 10% a year, that $1,000 becomes, at the end of year one, you get 10%, which is $100. So all of a sudden your $1,000 is $1,100. But in year two, even if you put $0 in, what's cool is your base is now $1,100, not $1,000. So you get 10% of $1,100, which isn't, $100, but is rather $110. And so that's the power of compound interest. And so the more you can save today when you're younger, I know we have a range of people on, but even if you're 40, you have 25 years before you're going to retire. So it's 25 years that your money can work for you. So I'm a big believer in buy and hold investing, AKA the opposite of GameStop. So I'm not trying to pick individual stocks. I'm not trying to, time exactly when the hedge funds are going to have to close their positions, which is going to help me in terms of that one stock. I'm trying to invest consistently each year, not guess when the market's going to go up or down. And hopefully, historically, the stock market, the largest 500 companies in the United States, is what the S&P 500 is, but it's grown at about 10 to 11% a year. And so while I don't have a crystal ball, I cannot guarantee or have any idea really what future market returns will be. I am using that historical record to say, okay, I'm going to continue to invest in stocks. It's been the best performing asset historically. And I'm going to put an amount of my money in the stock market every month. And hopefully by the time I get to 65, it's going to have grown. And my husband and I want to retire at 55 actually. So,
wow.
Yeah. And that's possible.
Hashtag life goals. I love that. We're going to talk more about goals and financial planning in a second. So I commend and support your goals. Okay, keep going. Early retirement and.
No, I was more going to just say, you asked about, investing in the S&P 500 or investing for the long term. And that's the power of what that does, is that hopefully, when I model out what do we need to retire by 55, I'm using 7% lower than that historical return that the S&P 500 has gotten. And there is this great resource, I'll put it in the chat, but you can go to the compound interest calculator at investor.gov and sort of get a sense of, okay, based on what I have today and how much I'm saving each month at a 7% growth rate, how much money would I have in 20, 30 years if you're in your 30s or even your 40s. And it's really powerful to sort of see, oh, wow, I'm on track for being a millionaire or maybe even a multimillionaire. And that number might seem big and scary, but that's sort of the power of consistent saving and compound interest over time.
I love that. I mean, this is like the something major version of Who Wants to Be a Millionaire, everybody, right? I would love to, retire like that. When we talk about this, I think one of the things you're implicitly talking about, but I'll connect the dots on too, is this idea that, and I want to acknowledge, I know, Eryn, we can see the attendees from our side of the Zoom, they can't see each other. I'm looking at the list, and just from the people that I know that are registered here, we have women from their late 20s to their mid 60s here with us today. So in all phases of, starting their careers, ending their careers, creating their next act, maybe even in their retirement. One of the things that, I have an I-401k. It's a special 401k you have when you're self-employed. There's lots of special rules and tax advantages. Self-employed people, please, please, please put into your I-401k. Eryn can tell us all the reasons why. But, one of the things, Eryn, that my bank allows me to do where I hold my brokerage is it just lets me pick my target retirement year. And to your point about picking index funds, set it and forget it, it just over time makes my investments while I'm still young, a little higher threshold for risk versus when I'm getting older, it's moving more of that money into bonds and bond funds. And so just making some smart upfront decisions, doing 5-10 minutes of research, talking to an advisor, talking to a friend can go such a long way in generating that long-term wealth.
Yes, and target date funds are great because they're pretty hands-off. So you don't have to be worried about what's my allocation look like. It does it automatically for you. So most people's 401ks default to a target date option. And like Randi explained, they have what's called a glide path where they go from more in stocks to less in stocks over time. And I think they're a really great option. I actually prefer them over robo-advisors. That's the question I get a lot is like, is Betterment, is Wealthfront, are they worth the hype? I think that they are great tools. But a target date fund will do very similar things and for a little bit cheaper because you do generally pay a robo-advisor an 0.25% fee of your money each year. So, when you're younger, maybe you have $50,000 invested, that 0.25% is not going to be that much. But as you get older, that fee is going to be a bigger and bigger dollar amount, even though the percentage stays the same as you have more money invested. But I think that there's a lot of ways that you can very cheaply, because even Betterment or Wealthfront, those are really cheap. If you pay an advisor to invest your money for you, you might be paying 1% or more of your total assets. So if you have, $1 million, 1% of $1 million is $10,000 a year. So that's a lot of money to be paying. And if you have more complex finances, it could make sense. If you have cross-border finances, if you are, have a $2 million estate, that makes sense. But for the average person, you probably can use a target date fund or a robo-advisor to get 95% of the way there yourself.
I love that. And we're going to take a question about goals in just a second. But Eryn, I can't, while we're on the topic of 401ks, I go back to the fact that in so many ways, I remember just on a personal level, when you were starting her personal finance, so much of this came from the fact that women, we start new jobs and we never set up the 401k employee paperwork for our matches. It's cumbersome. Frankly, companies make it really hard. Before we take a question and move on to kind of goal planning and financial planning around our goals, while we're on this topic of 401ks, can you just remind us about finding free money at work and understanding what our matches are and how to take advantage of this? Because every woman needs to do this.
Yes, for sure. And I know some people don't like that you call it free money because they're like, it's part of your compensation package. If you're working for it and you're just not taking advantage of it. So that is, I guess, another way of saying free.
Oh, so it's almost like lost wages. So instead of free money, this is really about claiming lost wages.
I have never heard it framed like that, but I think that's perfect because I feel like that's even more motivating than
all right, trademark
money.
something major 2021. You all saw it here. I own the copyright on that.
Yes. So I think that HR is a really great resource because they can often really simply answer the question for you, what is my 401k match or my 403b if you work for a nonprofit or the government? And I would just try to understand that. Sometimes the language is really confusing. They'll refer to your 401k contribution as deferred compensation, which I know trips people up. So I just had a woman say to me, hey, Eryn, like this is the exact language from my company. It says we match, 0.5% of your first 3% of deferred compensation. She's like, what the heck does that mean?
So, oh my God, I'm like, my head is spinning.
Yeah, it's not easy, but when they say deferred compensation, that's basically money you're putting into a 401k because you're deferring it to the future. So anything that goes into one of those accounts will be referred that way. And a lot of companies, what they do to try to incentivize you to save more, they will say, we'll give you a percentage of whatever you're saving up to a certain amount. Maybe it's 4% or 5% or 6% because they want you to save at least that much. So if they say we'll put in, 0.5% for up to 6%, they're basically matching. They're giving you 3% of your salary as a match, but you have to put in 6% to get it. But ask HR, ask a friend who's at the company, like they can probably explain it to you. Be careful if you ask a friend. Sometimes there's misinformation going around. But I also really wanted to say that sometimes people think I only should save in my 401k or my 403b up into the match because that's all my company is incentivizing. But you can put $19,500 into an employer 401k. If you do have an individual, if you're an entrepreneur, you have slightly different accounts and the rules are a little bit different. But one of the great things about being an entrepreneur, while you don't get a match, is that there are retirement accounts that let you put in a lot more money. And it's not just an individual 401k. It could be a SEP IRA. There's a couple different options there. But focusing on people that have a job through their employer, you get a paycheck each month, which, hey, as an entrepreneur, I kind of miss those days sometimes. And you're like, how much money am I going to miss this month? I know you can relate to that, Randy.
Calculating my own taxes and 401k, thank God I have a great accountant, but we can talk about that. We'll do another session just for people who are self-employed. It is mind-boggling, but keep going, Eryn.
Yes. We won't talk more about that, but let me say, when they take the taxes out of your paycheck, it definitely feels better than when you have to take cash and say, oh, I owe, $7,000 this quarter or whatever that is. So let me just say that you can put $19,500 into a 401k, and irrespective of what your company matches, that's money for you. So when we talked about compound interest earlier, if you put in $10,000 this year, that $10,000 is just going to grow each year. Again, the stock market isn't guaranteed to go up, but on average, historically, over a 20, 30-year period, it's gotten these 10, 11% returns. And so the more you're saving, the more that money has an opportunity to grow. So don't feel like you're limited by just putting in what your employer matches up to. You can put in a full $19,500. Your employer match doesn't count until towards that cap. And for those of you that are high earners, really making sure you take advantage of that. It also can help lower your taxes. So don't get stuck on what your employer is matching.
Yeah. And, this is so important. I just remember back to my very first job. I won't tell you how much I was making. I'll just tell you it was not a lot. My husband and I were living, Eryn, I think you've had Shabbat dinner at my table in this apartment on Connecticut Avenue, in this teeny, tiny apartment with this galley kitchen without a dishwasher. And I just remember how bad it hurt to take that money out of my 401k and save. Flash forward years later, when I was consolidating all my 401ks and moving them to an I-401k, which is, again, something you can have if you're self-employed, I was like, holy cow, right? Eryn, that interest calculator, it's no joke, right? It really does add up over time. And I do want to say, again, I know we have some people who are self-employed with us today. Again, just like for people in the corporate space, it can actually help bring down your tax bill if you are self-employed. And a great accountant can help you figure that out over a certain revenue threshold. So Eryn, we're going to move on to some questions that we've had. I want to encourage you to keep submitting your questions. We got one question, which I'll just answer quickly live. Will I share this recording? Absolutely, Caroline. We'll be sending out an email with the recording and with lots of great resources from Eryn. So stay tuned for that. And then we got another question, and we're going to talk a little bit more about goals. And we want to hear from you all, right? Do you have questions about buying a house, saving for a down payment, buying a beach house, paying off your student loan debt, saving for your kids to go to college, tax day, which by the way was deferred, so hasn't happened yet. We want to hear from you. What are the things that you have questions about? And we'll go to one question that has come in so far. Eryn, this is obviously for you, not me. What advice do you have on planning for long-term expenses where you don't have a hard dollar amount for? So for example, she talks about right now, she and her husband are dinks, they're double income, no kids, but they know that they want to start a family like in the next 2 to 3 years or so. Should they have a separate kid saving account now? Should they just keep their savings in an existing account? And likewise, she asked, would you recommend that we bucket our savings accounts for things like home and family and travel? So Eryn, just to bottom line it, I think the question we're really getting here is, how do I think about what my goals are and then build a strategy, whether it's kids or a house or a down payment, around what that strategy is, especially if it's like, I just know daycare is expensive or I know college is expensive, but I don't know an exact target amount. So Eryn, what advice do you have here?
It's a really good question, and I'm going to do my best because there's a lot of different layers to it. But I think that starting by doing some research into what are all these different things going to cost, particularly with kids. I know that everybody wants to start, a family and like kind of put the best foot forward for their children. But one of the best things you can do before you even start saving for kids specifically is to get your financial house in order. So that's if you have any high interest debt, paying that off, building up an emergency fund. I know I'm not a mom yet, but I know Randi can attest that things come up when you're a parent that are probably at a higher rate than when you are two adults that don't accidentally push a marble up their nose or whatever that thing is for your kid. I just think, both of my siblings, one of them broke both of his legs before he was 3 doing shenanigans. My sister had stitches. I think things come up more so when you have kids than when you are a non-clumsy 20 or 30 something. And so building up an emergency fund, which is looking at your spending, multiplying that by 5 to 6. Sometimes if you have kids, people want to have closer to a year of expenses so that if you lost your job or you had to take care of your kid full time, that you would be able to afford your mortgage or your, life, whatever that looks like for a year. So starting with high interest debt, building up an emergency fund, paying off student loans or anything else like that as a good first step. But then I think the second step is to dig in and really try to understand, what is this going to cost in my area? So if you know that you want to take 6 months off after you have a kid, that's actually a goal I find people miss sometimes. Maybe you only get 3 months of paid maternity leave.
Yes. I hear this all the time, just to jump in, right? Which is they want to take more time off. Their company is willing to give it unpaid, but this is happening T-minus 4 months before their due date. And they're thinking to themselves, well, to the question asker's point, I'm a dink, double income, no kids, my mortgage, my bills, everything's predicated on 2 incomes. How do I balance this? So I just want to normalize that, because a lot of times when women come to me, at least, about it, they kind of feel ashamed that they hadn't thought about it, or ashamed that they can't do it. So I just want to normalize that and take the shame factor out. And Eryn, please, back to you on your tips for how to actually financially do this.
Well, so I think, Randi, to your point, just thinking about and talking to other parents to try to get an understanding of, okay, in my area, what are things that I'm not thinking about? If you want a doula, if you want a night nurse, or you're going to need a lactation consultant, I think there are more one-time expenses in that first year of having a kid.
Yeah. So
having a $20,000 to $30,000 fund, and to your point that you don't know exactly what you might need that for, but it on top of the emergency fund. And in that case, I would say don't have a year emergency fund. Maybe you have 5 months, but I do bucket my dollars. I really like using Ally because it allows you to bucket your high yield savings account. And so I have my emergency fund tags. You can have a house down payment. You can have a wedding fund. You can have a kid fund. I know Randi will totally agree with this. A lot of the costs, unfortunately, of having a kid are ongoing. So particularly if you are going to buy a house, you know, create a budget where you layer in daycare costs and make sure that that mortgage payment plus childcare, if that's something, someone's going to have to care for that child. If you're lucky enough to have a family member who can do that for free, that's great. But if you're going to stay home or your partner's going to stay home to take care of that child, then you need to adjust from an income perspective to say, okay, we're not dinks anymore. We're, I don't even know, we're not even sinks because we now have a kid. We're C's, whatever that is.
Yes. We'll figure out the acronym and report back to you. Eryn will put it in her Instagram stories, right? Is that the point is that our life just changes. And Eryn, you know, I'm so passionate about watching women grow their careers and growing their families. And if I could just take a second to share some of my own personal experiences with this, the truth was my husband and I were savers, right? We never got over our skis in terms of our living expenses or anything like that. But the truth was I live here in Metro DC. A good quality, not even fancy, run-of-the-mill daycare costs between $2,000 and $2,500 a month per kid. It was just plain math. When I was pregnant with my first kid, we just couldn't afford to keep our lifestyle and send our daughter to daycare unless something changed. So I got a promotion and my husband got a promotion. Now, that's not a guarantee, but I will say that oftentimes women tend to pull back in their childbearing years. And I want to encourage you to keep pushing forward. Go for the promotion. Go for the raise. No one's going to give you a raise because your kid is, going to daycare. But I want to, unpack this myth that our careers stall. The social science tells us we have a lot of headwinds during our childbearing years. But I find that for a lot of women, it's the financial piece. It's a little scary, but can be a great motivator for them. And I know that was something for us that was just like, listen, like either something's going to change for us at work or our lifestyle is going to change. And that was just the reality.
Well, but I love that, Randi, because I think that when you make that budget and you say, okay, what does this look like with childcare? If the numbers don't show up or come out the way you want, Randi's a great example. You can change the income side of the equation. Sometimes we focus on how do I change the spending side? And especially when you're earlier in your career, there might not be a lot of room to cut, but there might be a lot of room to grow. And it could look like getting a promotion. It could look like starting a business on the side. There's a lot of different ways to do it. And so having that time in advance is really powerful. But unfortunately, especially if you want multiple children, you're probably not going to be able to save enough in a 2-year period to pay for 6 years of childcare times 2 children. It's going to have to probably come out of your monthly budget. And I'd say when you're making the monthly budget, also having a conversation, if you're a single parent, you have this conversation with yourself. But if you're partnered, thinking about, okay, what do we want to do for college? Is it important for us to pay for 4-year private school? Do we just want to pay for public school education? And there's a lot of calculators. I can put one in the follow-up materials for people trying to think about college, but you probably need to save about $500 a month if you want to fully fund private college. But I think college to me is something you layer on after you figured out your retirement, after you've paid off any debt. They say you have to put on your oxygen mask before you think about your kids. There's no financial aid for retirement. There is financial aid for college. It's also so hard to say in 18 years, what is college going to look like? I've had a lot of parents say to me, like, I'm not convinced that the education I got is going to be the right education for my child. So I would just make sure that you're not prioritizing saving for college before you're thinking about all of these other things. And also, maybe you can't save for college in those first couple of years when you have childcare expenses and maybe you're earlier in your career, but maybe you can start saving in a more meaningful way when your kids are older. You can also, if you're blessed to have friends or family or grandparents contributing, you can ask for a 529, which is a name of a college saving account, contributions in lieu of baby gifts or Christmas gifts, which can kind of help jumpstart that process. So there's lots of ways to save for college, even if you're looking at all the things you want, and it's hard to see where that money is going to come from. But the priority is retirement, childcare, the basics, and then layer on the extras.
Yeah, and we just got a question about that, which we'll just loop back around to in 1 second. But, you know, it's, I just want to say, because Eryn, you and I have had this conversation before. I've come and spoken to your boot camp class. You're here talking to something major. We've done events together. There's always a range of reactions when we have this conversation. Some of you might be sitting here feeling like, wow, I feel really empowered with this knowledge. Some of you might be sitting here saying, like, I feel a little overwhelmed. I just want to say it is a little overwhelming, right? That's the whole point about why we don't talk about this enough. And so everything Eryn is saying is a great idea. And it's about thinking about the things that resonate for you. And I just want to encourage everyone to think about where's one place where you can start to make a difference in your life, right? Eryn, I'll just say one more personal anecdote. When you talk about the emergency fund, it's so important. When I decided to take something major full time, I was honestly really scared. You know, I had enough proof of concept in my business as a quote unquote side hustle, which I don't love that term. We can talk about that another time. But it certainly was not going to replace the corporate income that I had that funded 2 kids to go to a quality daycare in Washington, D.C. Like, I'm not even talking about like a fancy car. Like, I'm talking about like safe, reliable childcare. And the emergency fund, I mean, it was scary, but you know, I paid the daycare bill with my emergency saving fund for months as I was getting my business off the ground. And that is what enabled me to ultimately take my goal and follow my dream of taking this business full time. And so I just want to again throw a public service announcement out there to people, which is if you're feeling overwhelmed, that's totally okay. But your dreams are connected to your money. Your money is connected to being an accelerant or a decelerant on your goals. And that's why this conversation is so, so, so important. Eryn, we got one question. Again, if you have more questions, we have time for a few more. Do send them in. And we got a few in advance that we'll go to if we don't hear from you. Just, you know, and Eryn, I think you kind of answered this, which is just like, how do we balance retirement savings with college savings? And I think what I heard you say is that they're both important, but ultimately, if you need financial aid, it's there for your kids, not for you. Anything else that you would kind of add to this question that came in?
Yes, because I think that sometimes people are like, I'm saving for retirement, but am I on track? And because you're not sure, it gives you this sense of anxiety. And I also want to say, you know, I'm a financial educator full time, and I still get anxiety thinking about the size of some of these numbers sometimes, but it can be easy to default to say, I'm just not going to think about it. And unfortunately, that's not going to help you get to where you want to go. So sometimes, you know, you got to pull off the Band-Aid and have that initial discomfort of like, okay, these are big numbers, but I'm going to sit with it. I'm going to make a plan around it so that in 18 years when my kid's going off to college, like I feel confident that I don't feel regret or sadness that I didn't do things differently. What I did want to say on retirement as a good benchmark is that by the time you're 30, you should have about your salary saved for retirement. By the time you're 35, you want to have about 1.5 times your salary. And by the time you're 40, 2 times your salary. And those are really high level benchmarks. They're from Fidelity. But the reason that they link to your salary and not an absolute dollar amount is most people spend to what they earn. So if you get a raise, you start to spend more. If you're you know, not making as much, you tend to spend less. So sometimes that number can be misleading. I work with a lot of women who are recent MBA grads or recent doctors, and those numbers are a little bit misleading because let's say you spent 2 years in grad school and then your salary doubled. You probably aren't going to have your salary saved for retirement because you weren't making that much before grad school and then you just spent 2 years out of the workforce. So take those numbers with a grain of salt, but they should give you a sense of where you're at a high level. And so especially if you're not where you want to be for retirement, that's totally okay. But that needs to be the priority because they actually say, I think 1 in 5 millennials were already supporting our parents in retirement. Baby boomers didn't save enough for a variety of reasons. And it's pressure on your kids later if they're going to have to help you in retirement. And it's a much different and better conversation. You know, you can pick where you get your education based on the cost and a lot of different factors. And, you know, I was blessed to get to go to private college and a private MBA, but, you know, I really think all the time, like, was the cost of that education, would I really be in that different of a place? My husband went to Georgia on the Hope Scholarship for free and got a fully funded PhD and had zero loan debt. I had $150,000. You know, there were multiple paths that I could have taken, and money was one piece of it. And I think that you can set your children up for success in lots of different ways, but you got to take care of yourself first.
And Eryn, you're hitting on something that's so important when we talk about goal setting. You know, when I work with my clients on goal setting, I often think about with them, there's different categories, right? It gets overwhelming when we try and set some blanket goal. When we actually start to map out almost in a quadrant, what are my personal goals, my family and relationships goals, my professional goals, and our financial goals, we can segment out all the different pieces so that we can integrate them together. And that helps us start, to your point about breaking up goals into small pieces. It helps us it helps us from not falling into the trap of getting overwhelmed by the overwhelm itself, right? Which is like, there's so much information here, I don't know what to do. It's like the equivalent of starting the diet tomorrow. And so I love, right? Right. I mean, and I will be honest, I was at a company that made it kind of hard to set up a 401k. You had to be there for 90 days, and then at 90 days you could sign up, and then your match started after that. And I just got so busy, I didn't do it. And then I got so overwhelmed by the overwhelm itself that I've missed out on you know, money that's mine, right? In those matches. And these things really do add up over time. And Eryn, to your point about our specificity of our goals, I love this. I think, can't remember if you posted this yesterday on Instagram or LinkedIn, but you gave this great example about how does it change when we say, I want to buy a house versus I want to buy a $500,000 home and put 20% down. So when we kind of clarify and name our goals, own our goals, Eryn, I mean, from a coaching perspective, I have lots of thoughts about why that makes a big difference. But tell us from a financial perspective, why something like that makes a profound difference in our ability to achieve those goals.
Thanks, Randi. I think that a lot of it for me is automating towards your goals. So something that I do in my class is I have everybody fill out a goal prioritization template where you write down all the things that you want to do. And you write down how much cash it's going to take each month in order to get there. So in the example that you gave about buying a house, if you want to buy a $500,000 house with 20% down, that's going to be $100,000. If you want to do that in 3 years, well, how do you back into the monthly amount that you need to save in order to get there? So you're going to take $100,000, you're going to divide it by 3 times 12, because you have 12 months in the year. So you have 36 payments in which to come up with that $100,000. Some people are going to have a bonus payment that's maybe going to be a lot of that money. If you're blessed enough to have a bonus, that's awesome. But what I like for people to do is to write down all the things that they want to do. And I'll give an example from my personal life, which is that I wanted to start a business and have a business fund, to your point, Randi, be able to cover my costs while I'm getting everything set up. I wanted to pay off my student loans because I was getting married. My husband had no debt, had never had loans. I was like, I am not going to be the reason that he has loans for the first time. And, you know, buying a house was something that was kind of on the radar too. But as I put all those things together, and this is on top of living a life that we enjoy, traveling, doing things that are fun as well, I realized, like, I want to start the business and I want to pay off my loans way more than I want to buy a house. And so I'm going to put that off. And it also didn't make sense for us because we aren't sure where we want to live. And generally you want to stay in a home that you buy for at least 5 years. So first of all, when you write it all down, it can help you identify those trade-offs and say, okay, I don't have enough cash to do all those things in a given month. What's more important to me? But second, you can automate. So you can say, okay, if I want to pay off my loans or buy a house in this amount of time, it's going to be $1,000 a month. And you can automate a transfer. You can have a high yield savings account, which I really like because you get a little more interest in there than you do in a bank account. And you can transfer that cash every month to that account, and you're building towards that goal over time. Instead of, I know we've all been there, where you said, hey, I want to do this thing this year, and you didn't create behaviors to get there every month. Yes. And the year passes and you're no closer to the goal than you were at the beginning. So setting that SMART goal and then taking the additional step of figuring out what does that look like on a monthly basis and how do I automate it yeah, I'd much rather have that down payment than, new clothes hanging in my closet, or even a trip that, going to a bachelorette party or something that like wasn't as value add to me.
Yeah, and I just find that making the plan is so empowering. Back when my husband and I were on the shoestring budget in the galley kitchen apartment, and I'm just laughing because you could attest to like how teeny tiny, and we were so proud of this home, how teeny tiny this home was. We started saving for travel and we started saving for different projects. And it's just been a behavior that has stuck and has made me feel so in control. And I just know that, just from a coaching perspective, that just actually identifying our goals and taking small steps towards them, that's always a slam dunk. So hooray for doing that with our money. Eryn, we have a few minutes left probably for one more question, and then we're going to spend a few minutes wrapping and sharing some exciting news and ways that we can stay in touch here at Something Major and with you. Tax day is coming. Tax day was deferred because basically the pandemic makes life super hard. So what are some of, just quick kind of lightning round style, what are some of the pieces of advice that you have for women on tax day?
Yeah, so one of them is about maxing out your retirement accounts if you're worried about taxes, and that not everyone needs to or is in a position to save $19,500 a year in their 401k. But if you're a high earner, putting that full amount in is really helpful. And we actually got a question in the chat that was, can you explain how that lowers your taxes? And they specifically said, how can the employee match lower your taxes? So your match does not lower your taxes, but the way taxes work is they're stair step. So some people don't realize that, let's say you make $150,000 and you're single, and that means you're in the 24% marginal tax bracket. You don't pay 24% in taxes on all the dollars you make. You only pay that on dollars above $86,000. Your first 10K in income, basically, you pay 10% tax on. And then the next 30K, you pay 12%. You can Google up tax brackets and find some more information. But the more money that you put into, there's two ways you can save in a 401k. You can put the money in a traditional account where you're paying no taxes today and you pay the taxes in the future, or you can pay the taxes today. But using those retirement accounts gives you advantages. Sometimes I'll see people saving in a brokerage account and a retirement account. And if you're using that brokerage dollars for a down payment on a house that's in the next 5 years,
something you need access to, right? Because you're going to get penalized if you draw down from your 401k, unless of certain circumstances that we don't exactly have time to go through today. But basically, brokerage if I want it soon, 401k if I'm fine with it for later, right?
Exactly. And the great thing about the 401k is that you get these tax perks. So if you put the money in a traditional account and you're in the 32% tax bracket, the $19,500 that you put in, you're not going to have to pay that highest marginal tax rate on it because they take the money off the top, if that makes sense. And then on the flip side, and this is particularly relevant, again, I work with a lot of women who have just graduated from or are in a grad program. If you are, so let's say you graduated from an MBA program this year, you have a high salary, so you're making $150K, but you're only going to make half that salary this year. In that case, putting your money in a Roth account can make a lot of sense because you're going to pay taxes on your lower salary and you're going to lock in that rate, and all that growth gets to happen. The money will come out tax-free. So if you put 10K in now and it grows to 100K, that 90K is going to come out tax-free. So your employer match, it's a more complicated question, but it's not necessarily going to lower your taxes. Generally, your employer match is put into a traditional 401k, so you won't pay taxes on that money today. So that actually is kind of a way that it lowers your taxes. But in general, 401ks are a great way to reduce taxes, as are IRAs. And happy to answer more questions on that if people have them.
Yeah, well, we're going to give everyone your contact information because we're going to have to bring it to a close in just a few minutes. I just want to put a plug in there for any of the women here who are self-employed or have their own businesses. The biggest kind of hack that my accountant gave me for taxes for being self-employed is that, I guess, Eryn, correct me if I'm wrong, there's something in the CARES Act that says if you're self-employed and you had to take time during the pandemic to take days off of work to parent your children, you are eligible for a certain type of tax credit. And for any of the working moms out there who will relate to this, I did the math, and over the course of 7 months where I didn't have any childcare, I took 107 half days. And that just blew my mind about just the impact that the pandemic has had on us as working mothers, on us as women. And I think, Eryn, we're here halfway between women equals pay, Women's Equal Pay Day, which was on March 24th, and Tax Day, which is coming up on May 17th. And I'm just so glad that we can have a conversation with you all today, Eryn, with you, about how we can marry our money to our goals, how we can feel more in control, feel like we're more empowered and more educated. And so, Eryn, I couldn't thank you enough for joining us today. And I want to encourage everyone, I'm going to be sending Eryn's contact information out. If you want to get smarter while you're drinking your coffee in the morning, just follow her on Instagram. She does the best stories. They make me laugh. They're so obvious, so actionable. Like, I'm like, oh, I never thought about that. That's so obvious, so easy, so doable. We'll also be sharing Eryn's site. She teaches an amazing class if you're interested. And I'm looking forward to hanging out with all of you. Again, thank you again for coming. Again, I'm Randi Braun. I'm an executive coach and the founder of Something Major. I want to share a few upcoming events that we have. Tomorrow night, if you are a working mom, we're doing our next Working Moms Burnout Boot Camp. I'm sitting down with Ann Gilliard, who is the founder of Grow Playrooms, to help us think about how we can reclaim space in our house when it's work and school and playroom and just basically like I had to clean up all of these things that were behind me before because it was so messy, even though this is my office. So we're going to talk about increasing flow, increasing creativity, increasing boundaries by reclaiming space in our house. I also want to encourage you to join our next Let's Do Lunch on Thursday, May 20th. I'm going to be sitting down with Dr. Sierra Kaler-Jones for a conversation about how we own our message. Dr. Kaler-Jones is a social justice advocate, a storyteller, a public speaking coach. She's going to talk about how we can own our message and speak more confidently. Finally, thank you to those of you who took the survey. We are dotting our I's and crossing our T's on the final details, but I do believe Something Major is going to be doing its first in-person event on Friday, June 18th at the Four Seasons Hotel here in Georgetown, a mini retreat all outdoors for working moms. So check out, we'll be sending more information about that hopefully soon. Like I said, dotting I's, crossing T's, there's a lot of rules we gotta follow, but feel comfortable enough to share that date and hope to see some of you there. Thank you all again for coming. Those of you who joined from near and far, those of you first timers and return Something Major event guests, we look forward to seeing you at the next event. Eryn, thank you again. It's such a pleasure to hang out with you and such a treat to share you with the Something Major community.
Thank you for having me, Randi, and you're a wonderful facilitator, wonderful to talk as always.
I mean, I just love talking to you. So thank you all again. And with that, we will bid you adieu and see you soon. Take care, everyone. Be well.